and welcome to Pro Trader Strategies Market Commentary for Tuesday, April the 28th. I'm Eric Wilkinson, and you very well may recognize me as the Wolfman from mainstream media, where I've talked about everything from economic to geopolitical, and on top of that, market analysis. Well, in these daily market commentaries, I do just that same thing, but I layer on top of it some option strategies that I find that we can implement into a portfolio. But please remember, these are not trade recommendations, and past performance of any trading system or methodology is not necessarily indicative of future results. All right, without further ado, let's get on with that economic data, because it seems like it actually moved the market a little bit today. We've been talking about how some of these economic data points aren't really forward-looking enough to capture all of this coronavirus fear and the pandemic. Well, we're starting to see some of the repercussions of this in these data points. So let's talk about the economic data. We got preliminary wholesale inventories, and that came in at negative 1%. Now, it was expected to be negative 0.4%. So that's better than expected. These companies are moving inventories. One thing to keep in note, a lot of the manufacturing has shut down. So they're moving old inventories rather than replenishing that inventory level. So when you don't jam more product into the inventory system, all you're doing is depleting what you already had in inventory. That's a good thing for your overall overhead, but it means that you could be caught behind the eight ball if demand continues to move. And I'm not surprised at this, to be quite honest, especially with the manufacturing shutdown. And I think there's a lot of people at home that are just online all day long and shopping, whether it's on eBay, Amazon, or wherever on the actual websites of these companies. But we're seeing them actually be able to move some inventories, and that is a good thing for those companies. Then we got the Richmond Fed manufacturing number, or Richmond Manufacturing Index, which is the Richmond Fed releases this. It came in at negative 53. All right, it was expected to be negative 41. The all-time low for this before today was negative like 43 or 44, and I think that this number goes all the way back to 1993. So that is now the worst number in the history of the Richmond Fed Manufacturing Index. So a bit of a wet blanket on the overall market with that one, but I tell you, I mean, we know that there's no manufacturing going on. There's a few of them, but not across the board. I mean, we even saw yesterday Tyson Foods, maybe it was even on Sunday, Tyson Foods announced that they were shutting down one of their pork plants not because of the system or a shock to the system. It was more that their employees just stopped showing up for work. So they decided that they needed to shut down production or the processing of pork. So that is actually going to be the shock to the supply chain to you and I. So we could start seeing pork prices drive higher as they aren't manufacturing these pigs. All right, Japan is a bank holiday, so could see a little bit lighter than normal volume, just to keep note of that. Now let's move on to the overall markets. Crude oil, it's trying to get itself out of this slump that it's been in, as we're starting to see like Australia and a couple of other countries start to look to open up some of the beaches in Australia and some other businesses. Now it's really scatterbrained for the most part between state to state as to how they are going to open up the different areas of the economy. Some of them are still saying that no restaurants, but you know, some of the other slightly more essential businesses will start to open up. I don't think you're going to see bars open up necessarily anytime soon. I saw a survey on Americans, and only 4 out of 10 or 2 out of 5 people are considering going to a sporting event after all of this until they find like a vaccine for coronavirus. So that means those guys are going to be struggling going into the year. Ticket prices could go down to try and drive some of that demand back, but it's going to be interesting to see how architects come up with ways to keep us slightly more separated than literally on top of each other at these different types of events. All right, but crude oil trying to make a bit of a move today. Now we're seeing gold have a bit of a comeback because the markets were higher this morning, but then with that Richmond Fed manufacturing survey or index, we started to see some weakness going on in the markets. We've had several days in a row of rallies in the equities, and I think that people are probably starting to think it's time to maybe lighten up some of my bullish position a little bit. I'm kind of in the same boat as well, so we'll talk about how I'm doing that here in a minute. But we're seeing gold start to make a comeback as those equities are starting to weaken. Bonds back up a point on the day. We got back into that 180 handle yesterday, and I talked about this. Anytime the bonds or the treasuries go below a certain level, we're starting to see some major Fed buying coming in. We saw good auction results out of yesterday's 2- and 5-year notes, so that's also giving a bit of a lift to these treasuries as well. Then we move over to the VIX. It is in positive territory. And you can see as a chart, it's looking like we may have found a bit of a bottom. Are people going out there and starting to buy some puts in around their underlying positions in order to protect some of these gains? Well, that's kind of what we're seeing get signaled over here in the VIX, is that people are starting to either purchase calls, which I don't think is necessarily the case right now because of the way that we've gotten these gains going on. I think it's more so people are going out there and buying some puts to protect the gains that they've seen over the past several weeks throughout this pandemic. Now here we have the Dow Jones Industrial Average just slightly in positive territory, up about 12 points, 13 points. But as you can see, we've had a nice move. We are, good thing with today is that we see the markets making a newer high. So that would be consistent with higher highs and lower or higher lows if, the market starts rolling back down. We definitely don't want to see it go below this tweezer area right here at 22,850-ish, let's call it. 22,800. 22,800, I would say. Let's say that's the line in the sand. Stay above that, and that would be consistent with creating these higher highs. Something I talked about yesterday also is we got above and settled above that 50-day moving average, which is a longer-term bullish trend. Remember, we talk about this a lot, where when we get into bullish trends, it's usually for the short-term trader is above that 9-day moving average. Now, if you're starting to look a little bit longer term, we're going to be talking about that 50-day moving average. There's a lot of things going on with these moving averages as they are signals to longer term market momentum, if you will. So we've gotten above that 9-day moving average, which is this line right here. So it's kind of looking like they're wanting to cross over, which is a bearish signal. But what I want you to know is that we are looking at the 50-day, which is this one right here. We settled above that point yesterday. So that is a nice bullish signal that the market is gaining a little bit of confidence going forward. We touched that value area low this morning too, and that's something we would like to see pierce back above and get back into the I don't want that. Get back into the value area, which is where the most time and volume has been spent. So you can see we're just below that right now, but right here is where the point of control is, and that is where the most time and volume has been spent. Are we going to get there right away? Blue chips, seems like they want to be dragging a little bit as we're seeing really more people put money into the Nasdaq, which is, more or less considered higher tech, right? Well, the S&P has a lot of names and it's been the dragger of the tech sector, if you will. And there's a lot of stocks in that index that are related to these home computer configurations or home office type things. So I think that if you're looking for a little bit of value in and around that space, look over there to the S&P stocks rather than necessarily the Nasdaq, because it has some high flyers in there that have been doing very well, but I think that they might be a little bit overdone to the upside, as you know, they've been getting a lot more media coverage as well. All right, Nasdaq is off by 100 points today, just better than that actually. It looks like it wants to pierce below this 9-day moving average. That's going to probably cause, if that happens, the 50-day and the 200-day crossover. And, you know, that is a longer bearish trend going forward. So, and I think that Nasdaq is a little bit overdone to the upside. So I think that that is almost a foregone conclusion. We've already seen it in the Dow and in the S&Ps. We just haven't seen it yet in the Nasdaq because it's been held up a little bit more than the rest of them. But again, it being above the value area high, a lot of these high flyer names in the Nasdaq have really shot up. Some of them even having 52-week highs, which I'm not necessarily saying that that is wrong, because I think that some of those have done very well and will do very well in this type of environment. So, but I do think that it's just a little bit ahead of itself and needs a bit more of a correction back into the value area, and that will almost surely make those cross and make it look like a longer term bearish trend. Now let's go over to the E-mini S&Ps, just slightly in negative territory. We are at the point of control. Now this is for the volume. This is for the time spent. It just means it's hung out there. There hasn't been a whole lot of transaction buying and selling going on at that level. That level is up there at 3,000. All right. So we haven't quite got there, but it is sandwiched between, lined up pretty nicely, as you can see, with a couple of Fibonacci's, and that is going to cause this market to maybe start pivoting back and forth, filling in a little bit of this area that has been at a low. So we could see it want to have a bit of resistance at that 3,000 psychological level. There's also that 200-day moving average there, but we have gotten above the 50-day, which is showing a little bit more strength in this market, a little bit more confidence, and I think that we're going to want to stay in and around here. That 27, 25 area is going to act as support. As you can see, it's done very nicely in the past, and I don't really see us going below that unless something terrible happens. People start opening up, like maybe Georgia opens up and starts seeing a real spike in these coronavirus testings and cases. So I think that we're working our way through this. Yes, the economy is still shut down, but these are futures. These are forward-looking products, and we're looking down the road basically to the fall almost, kind of, that we're going to be working ourselves out of this. Now let's take a look at the daily chart of the E-mini S&Ps, and actually the daily chart, I mean the breakdown of the daily chart. 30-minute candles, you can see right here, economic data starts being released. This is in and around where we got that Richmond Fed survey. It started getting a little weak right before, but the Richmond Fed survey really looking to be the catalyst that got this market selling off. We found a bit of a bottom here and are kind of working our way through it. Do I think we're going to go print those highs or at least retrace this? I don't think so. We've got a huge earnings this week. I've talked about it, like Microsoft, MasterCard, who else is there? We had we had Pepsi yesterday. They actually didn't do too bad. Facebook coming out. So this also, with that Richmond Fed manufacturing, this is probably where we're seeing some people, trim some of their long positions, maybe adding some puts to protect that position heading into this big week of earnings. Now let's talk about the trades that I've done. I went in and took the opposite of that, right? I've already been long these stocks. I've had them put to me for the most part across the board. But with this, I decided to go in and look to trim off some of my positions. So I did about half of my position on these covered calls in here. Want to take advantage of some of this high implied volatility we've got going on. I expect volatility to come out. Yes, it's probably not near the highs or really quote unquote meeting my guidelines for this in earnings. But when you expect that volatility to come out after the earnings, that's the time to be going in there and taking advantage of some of these premium selling strategies. In my case, I'm looking at covered calls. You guys remember I am long MasterCard at 256. That plus all of the, that's my average, all of the lowering of the basis where I've been going in and selling options against that position. Well, I'm doing the same thing. I'm not trying to do it for a complete cover on this trade. I'm doing it, like I said, for half of the position that I'm already long. And I went in and sold the May. I looked at the weeklies. The markets in here are pretty wide. So I went out to the May and I decided, you know what, if I can get out tomorrow for 50% of my max profit or just on the open for a nice profit, I might take those off. If it looks like I'm going to have those called away, I would be happy to get out at 290, right? So that puts me well above this area here, right in or around here, very close to the value area high. Collected $1.13 for it. So lowering my overall cost basis by about 55 cents, right? Because I'm doing it for half of my overall position. So if I look at it as my overall cost basis on this trade, I have to kind of cut that premium in half for that lower cost basis. So I'm lowering my overall cost basis on this trade by 55 cents per unit that I own. And if I get half of them called away, I'd be happy to get out at 290. That's a nice win, to be quite honest, and would get me above a couple of value areas there. And you know, I could start selling some puts in there to buy it back if I want to. I don't know if that's necessarily the case of what I want to do right now, but I definitely want to trim some of my profits, and this is the way I'm going to try and do that. If they have a good earnings, I'll be able to get out of some of those moving forward and still have it on if they really knock it out of the park, right? All right, so that's all I've done so far today. Looked at a couple of other trades, but nothing's really making me jump right now because I want to be able to have some powder left to trade some of these other earnings that I've got coming out later on this week as well. So I'm going to probably be playing Microsoft and Facebook tomorrow as well. All right, so without further ado, check this out. I am not trying to give you guys trade recommendations. We are just here to educate you on how we can lower our overall cost basis, how we can trade in and around that portfolio we have of stocks and lower what we paid for them synthetically by selling some options against them and dollar cost averaging, right? So all of those things are hypothetical. We're just trying to teach you guys by using me as an example in a sense. All right, that's all I got for you. Other than if you can't take that, take it easy.